Welcome to PIMCO Pod. In this episode, we take a deeper dive into U.S. labor market data that reveal troubling trends, which will likely prompt more Fed interest rate cuts. Stay tuned after the conclusion of the podcast for additional important information. Troubling Signals in U.S. Employment Data by Tiffany Wilding. Last week, the Federal Reserve resumed its rate-cutting cycle, lowering the policy rate by 25 basis points after being on hold since its previous cut in December. The Fed also adjusted its characterization of the risks to the economic outlook. Having focused primarily on inflation risks tied to tariff policies for most of the year, the September Fed statement downplayed inflation, describing it as somewhat elevated, and instead emphasized rising risks to the labor market, the other component of the Fed's dual mandate. Since the pandemic, the U.S. labor market has been tough to read. The unprecedented pace of business closures, new formations, and job switching challenged the ability of labor market surveys to capture real-time trends. See the 13th of August 2025 macro signposts, U.S. economic data. Reliability is crucial. A surge in immigration during 2023 and 2024 that is now reversing is adding further complexity to the economic signals. Beneath the surface of U.S. employment data, we find ourselves largely aligned with the Fed in seeing growing cause for concern. The labor market is absorbing shocks from trade and immigration policy, as well as technological disruption. Yet these vulnerabilities are less obvious in the headline payroll and unemployment figures. As noted in last week's macro signposts, the U.S. labor market appears to be bearing a larger than expected portion of the adjustment to new tariff policies, which may help explain why prices aren't rising significantly. Here is a closer look at the data driving our concerns about the U.S. labor market and why we anticipate additional Fed rate cuts this year. Notable deceleration in payroll gains. Payroll gains have decelerated sharply in 2025. According to headline figures from the U.S. Bureau of Labor Statistics Establishment Survey through August, monthly job growth has averaged just 75,000 per month year-to-date versus the 140,000 average pace at the same time last year. While the reported figures show a clear deceleration in payroll gains, they underestimate the magnitude of the actual deceleration. This is due to the methodology behind the BLS Establishment Survey, which relies on the so-called birth-death model to estimate monthly business closures and openings. When the economy faces a larger-than-average number of business births or deaths, the model has historically tended to over- or underestimate payrolls, respectively. In the past few years, this has led to an overstatement of actual job gains by 700,000 to 900,000 positions. Preliminary benchmark revisions showed that employment was overstated by more than 900,000 jobs as of March 2025, factoring in a likely continued overestimation in the months since March, plus an expected decline of roughly 150,000 in government payrolls set to appear in the October survey due to the early retirement package offered by the Trump administration, suggests payrolls may be down roughly 8,000 per month on average year-to-date, and by a more substantial 58,000 per month over the past 4 months, something that has never happened outside of a recession. Factors driving unemployment data. The modest 0.2 percentage point increase in the headline unemployment rate this year through August also masks more troubling underlying labor market weakness. Over the past several years, the BLS Household Survey has struggled to capture large changes in immigration flows in real time. In 2023 and 2024, rising immigration pushed up the unemployment rate as new workers took time to find jobs. However, with immigration trends reversing sharply in late 2024 and into 2025, the unemployment rate is now being held down by a declining labor force participation rate as many of these workers leave the labor force. Smoothing through the immigration swings, the factors driving the rise in the unemployment rate are eerily similar to trends observed ahead of the 2000 and 2008 recessions. Since July 2023, the roughly 0.8 percentage point increase in the unemployment rate has been driven mainly by a decline in the employment-to-population ratio, EPR. A decline in the labor force participation rate, LFPR, has counteracted some of the EPR's impact on the unemployment rate. However, that is not necessarily a good sign. The LFPR tends to be cyclical as more individuals stop looking for a job when labor market conditions deteriorate. Little firing, but little hiring. So far in 2025, the weakness in monthly payroll growth appears to be driven primarily by stalling hiring rates rather than an uptick in firing, according to the BLS's Job Openings and Labor Turnover Survey, JOLTS. If hiring continues to decline, payroll prints could turn more persistently negative, even without a rise in layoffs. This is exactly what happened ahead of the 2008 recession. In 2007, gross firing rates didn't pick up until 8 months after monthly payroll started to contract due to reduced hiring. The data show a similar pattern around the 2000 recession. The contraction in monthly payrolls was driven to a greater extent by a fall in gross hiring rates, with gross firing rates increasing only after a lag. Fiscal policy may ease some pressure on businesses and households. While the current labor market dynamics look concerningly similar to past recessionary periods, there are important differences today. Excluding the pandemic, labor market contractions since 2000 weren't the result of large policy changes. Rather, they were the consequences of the tech and housing sector busts. This time, offsetting tax cuts should provide U.S. businesses and households with more cash to help smooth the bumps from trade and immigration policies. According to Congressional Budget Office, CBO, and Joint Committee on Taxation, JCT estimates, retroactively applied tax credits could reduce aggregate business taxes by an estimated $100 billion in 2025. According to U.S. Treasury daily cash data, businesses have already started claiming those credits, contributing to a reduction in corporate tax receipts as of the mid-September payment. Similarly, households and individuals who have seen their tax payments increase alongside nominal income growth this year will likely enjoy larger than usual tax refund checks in early 2026. Enhanced child tax credits and refunds of overtime taxes paid in 2025, among other tax changes, should boost tax refunds and offer some support to U.S. households. While tax policy should take some pressure off firms to reduce headcount and offset some of the negative household real income shock, the benefits are unequal. Some companies and households will gain more than others. As we've argued in past pieces, companies and individuals more exposed to the trade sectors will likely face greater economic challenges, at least in the short run, while supply chains are reorienting, than companies and individuals that are operating in more capital-intensive industries. Individuals in industries that traditionally rely more heavily on immigrant labor could also see more persistent wage gains, supporting real incomes. Bottom line. Headline U.S. labor market figures mask far more concerning developments below the surface. Indeed, if history is a guide, the data project an economy that appears to be teetering on the brink of recession. New policies on tariffs, immigration, and government downsizing are all having an impact. Similar to the Fed, we are more concerned about downside risks to the labor market than upside risks to inflation. That said, signals of a potential recession don't necessarily mean it will happen. With more stimulative tax supports coming in 2026, real wages continuing to grow around 1%, according to the BLS, despite stagnant activity, and a robust tech investment cycle underway, there are reasons to believe the economy will pull through. For now, however, as we gain more clarity around how smoothly the U.S. economy adjusts to the new policy environment, the concerning signals in the details of the labor data likely point to lower interest rates. Thank you for listening. That was Troubling Signals in U.S. Employment Data. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.